Imagine waking up one morning and realizing the money you trusted your entire life is suddenly not enough. Your savings look the same on the screen, but everything around you feels more expensive. Grocery prices jump, fuel costs soar, and people around you start to panic. News channels repeat one word again and again: collapse. This exact moment has happened many times in history, and every single time, human behavior follows a familiar pattern. When trust in paper money and financial systems starts breaking, people rush towards something real, something limited, something that cannot be printed overnight. This is where precious metals enter the story, not as a theory, but as a reaction driven by fear, survival, and logic. If you want to understand why gold and silver demand explodes during economic collapses, you must first understand how panic rewrites the rules of supply and demand. Before we go deeper, make sure you like this video and subscribe to the channel. It helps support long-form deep content like this and ensures you never miss upcoming stories that most people never hear about until it's too late. Now let's continue. Every major economic collapse begins with confidence. As long as people believe the system works, money flows normally. Banks lend, governments print, and markets rise. But the moment confidence cracks, behavior changes fast. People stop thinking about profits and start thinking about protection. Cash feels unsafe, banks feel fragile, and promises feel empty. Precious metals, especially gold and silver, are different because their value does not depend on anyone's promise. They exist outside the system. That single fact alone changes everything when fear enters the economy. During collapses, demand for precious metals does not rise slowly, it surges suddenly. Millions of people try to buy at the same time, while supply remains almost fixed. Mines cannot increase production overnight. Refineries cannot magically double output. This imbalance creates pressure, and prices respond violently. What looks like a price spike is actually a trust collapse, showing itself through numbers. Throughout history, whenever currencies weakened or failed, precious metals became the silent refuge. This story repeats again and again across continents and generations. And once you see the pattern, you cannot unsee it. To understand how powerful this pattern is, we need to look at what really happens when an economy collapses. It is never just numbers falling on a screen. It is people lining up outside banks, governments announcing emergency measures, and markets moving faster than logic. In these moments, supply and demand stop behaving normally. Demand becomes emotional, urgent, and irrational, while supply stays slow, rigid, and limited. Precious metals sit right in the middle of this imbalance. Take gold as an example. Gold supply grows only a tiny percentage each year. New mines take years, sometimes decades, to develop. When a collapse hits, suddenly millions of new buyers appear overnight. They are not traders looking for small gains. They are families, institutions, and even governments trying to protect purchasing power. This creates instant pressure. Prices don't rise because gold changes. Prices rise because money loses credibility. Silver follows a similar path, but with even sharper moves. Unlike gold, silver has heavy industrial use. During normal times, supply is already tight because most silver is produced as a byproduct of other metals. When economic stress hits and investors rush in, there is simply not enough silver available to meet demand. Dealers run out, premiums rise, paper prices disconnect from physical reality. This is why silver often spikes harder and faster than gold during crises. History shows this clearly. In times of stability, precious metals move quietly, often boring investors, but collapses flip the script. The same assets that were ignored suddenly become the most desired. People who laughed at gold before now ask where to buy it. Those who never thought about silver start searching for physical bars and coins. This shift is not driven by charts. It is driven by fear and memory. Humans remember pain longer than profits. As collapses deepen, something else happens. Governments try to restore confidence by printing more money, cutting rates, and injecting liquidity. Ironically, these actions often increase demand for precious metals even more. The more money created, the more people question its future value. Demand rises again, supply stays fixed, and prices push higher. This cycle is played out repeatedly, and we are only just getting started in this story. One of the clearest examples of this pattern appeared during the Great Depression. When stock markets crashed and banks failed, people quickly learned that numbers on paper could disappear overnight. Demand for gold exploded as citizens tried to convert unstable currency into something permanent. At the same time, governments faced a different problem. As more people demanded gold, national reserves began to drain. Supply did not increase, but demand multiplied, forcing dramatic policy responses. This is when governments realized that precious metals were not just commodities, they were anchors of trust. As fear spread, people stopped asking how much gold cost and started asking how much protection it offered. This mindset shift is critical. During collapses, price becomes secondary. Availability becomes everything. When demand spikes faster than supply, even small shortages trigger panic buying. This pushes prices up further, creating a feedback loop where rising prices attract even more buyers. What looks like speculation from the outside is often survival behavior from the inside. Fast forward to more modern times, and the same mechanics appear again. In the 1970s, inflation surged, currencies weakened, and confidence in governments declined. Gold demand surged globally. Silver followed with even more extreme price movements because the market was smaller and easier to overwhelm. As more investors rushed in, supply simply could not keep up. The result was explosive price action that shocked those who believed metals were outdated. Another important detail often ignored is timing. Demand does not rise evenly throughout a collapse. It comes in waves. The first wave is driven by smart money and institutions. The second wave comes from the public once headlines turn negative. And the final wave happens when fear turns into desperation. By then, prices are already much higher and supply is stretched thin. This is why late buyers often feel priced out. Economic collapses expose weaknesses that were hidden during good times. They reveal how fragile financial systems can be and how quickly trust can vanish. Precious metals benefit not because they change, but because everything else does. As systems wobble, people instinctively reach for what has survived every collapse before. And this instinct, repeated across history, continues to shape demand and drive prices higher when it matters most. When we move into the late 1990s and early 2000s, many people believed economic collapses were a thing of the past. Technology was booming, markets were soaring, and confidence felt unbreakable. But beneath the surface, debt was quietly growing. When the dot-com bubble burst, trillions in paper wealth vanished almost instantly. Once again, demand patterns shifted. Investors who had trusted stocks alone started looking for balance. Gold demand began rising steadily, not in panic yet, but in preparation. Then came the global financial crisis of 2008, a perfect case study of how collapses fuel precious metal demand. Banks failed, major institutions collapsed, and governments stepped in with massive bailouts. For the average person, this was a wake-up call. If banks could fail and savings could be frozen, what was truly safe? Gold and silver demand surged worldwide. Coin shops saw long lines. Online dealers ran out of inventory. Supply chains struggled to keep up. What made 2008 unique was speed. Information traveled faster than ever. Fear spread globally within hours. This caused demand for precious metals to spike almost instantly, while supply remained slow and limited. Mines could not respond. Refineries could not scale fast enough. The imbalance became extreme. Prices climbed sharply, but more importantly, physical metals became hard to find. Premiums rose far above spot prices, revealing a gap between paper markets and real demand. Silver showed especially dramatic behavior. Because it is both a monetary metal and an industrial one, supply was already tight. As investors rushed in, shortages appeared quickly. This pushed prices upward at a pace that surprised even experienced investors. The lesson was clear. In a collapse, size matters. Smaller markets like silver can move violently when demand overwhelms supply. As governments responded with stimulus and money creation, trust weakened further. Each new bailout sent a message that the system required constant support. That message fueled even more demand for precious metals. People were no longer just reacting to the crisis. They were preparing for the next one. And this shift in mindset is what turns temporary spikes into long-term trends. After 2008, many believed the worst was over, but something important had changed permanently. Trust had been damaged. Even as markets recovered on the surface, demand for precious metals stayed strong. Central banks, which had once been sellers of gold, quietly became buyers again. This was not emotional behavior, it was strategic. When institutions that control currencies start accumulating gold, it sends a powerful signal about long-term confidence in paper money. During periods of heavy money printing, supply and demand dynamics become even more distorted. As trillions of new dollars enter the system, the relative scarcity of precious metals becomes more obvious. Gold supply barely changes, silver supply struggles to keep up, but currency supply explodes. This widening gap pushes prices higher over time. What looks like appreciation in metals is often depreciation in money. Another major moment came during the pandemic-driven economic shock. Within weeks, global economies shut down, stock markets crashed, supply chains broke, and uncertainty ruled everything. Demand for precious metals surged instantly. Dealers reported record sales. Some could not deliver physical metals at any price. This was not speculation. This was people reacting to uncertainty they could not measure or predict. What made this collapse unique was how fast fear translated into action. People did not wait for months. They bought immediately. Gold prices spiked, silver followed with extreme volatility, and premiums on physical metals soared. Even when paper prices pulled back, physical demand stayed strong. This revealed a crucial truth. In real crises, paper markets and physical markets behave very differently. As demand surged, supply constraints became more visible. Mines shut down temporarily. Refineries slowed. Transportation faced delays. This further tightened supply at the worst possible moment. When demand rises while supply actually falls, price pressure becomes unavoidable. This is the perfect environment for sharp spikes. Economic collapses are not just financial events, they're psychological shifts. Once people experience one major collapse, they never look at money the same way again. Each new crisis builds on the memory of the last. This layered fear keeps long-term demand for precious metals alive, even during periods of calm, setting the stage for future spikes when the next collapse arrives. Another critical element in every economic collapse is government reaction. When systems start breaking, authorities rarely allow markets to reset naturally. Instead, they intervene. Interest rates are cut, money is injected, and debt levels rise sharply. These actions are meant to calm markets, but they also change behavior. Savers realize that low rates punish cash holders, while rising debt weakens currency strength. This realization quietly increases demand for precious metals over time. Supply, however, does not respond to policy. Gold cannot be printed, and silver cannot be created by decree. Even recycling takes time and effort. This is why each new round of stimulus slowly tightens the supply-demand balance. Investors who understand this don't wait for panic. They position early. By the time fear becomes public, supply is already stressed and prices are moving fast. Another overlooked factor is global synchronization. In past centuries, collapses were often local. Today, economies are connected. When one major economy struggles, the impact spreads everywhere. This creates simultaneous demand across multiple regions. When buyers from different countries rush toward the same limited assets, pressure multiplies. A gold coin or silver bar can only exist in one place at one time. As demand grows, market psychology shifts. Media narratives change. Precious metals move from being called outdated to being called essential. Analysts who ignored them begin discussing shortages. This narrative shift attracts a new wave of buyers who were previously on the sidelines. Once again, demand increases without any meaningful increase in supply. Price spikes during collapses are not random. They are signals. They reflect stress, fear, and imbalance. Each spike tells a story about trust leaving the system and flowing into something solid. Over time, these spikes form a pattern that repeats with remarkable consistency. Those who study this pattern understand that collapses do not create demand for precious metals. They reveal demand that was always there, waiting for a reason to act. As collapses drag on, another powerful force enters the picture: scarcity awareness. People don't just want precious metals anymore, they want them now. This urgency changes buying behavior completely. Instead of asking about price, buyers ask about availability and delivery time. When sellers say out of stock or weeks of delay, demand intensifies even more. This is how shortages feed themselves. Fear of missing out combines with fear of collapse, creating explosive pressure on a very small market. At this stage, we often see a disconnect between official prices and real-world prices. Paper markets may show stability, but physical buyers pay much more. This happens because paper contracts can be created endlessly, while physical metal cannot. During collapses, people lose trust in paper claims and demand real ownership. This shift drains inventories quickly. Vaults empty, dealers ration supply, and premiums climb higher and higher. Another layer of demand comes from institutions. Pension funds, insurance companies, and even sovereign wealth funds quietly increase exposure to precious metals when instability grows. These players move large amounts of capital. When they enter a market with limited supply, the impact is massive. Unlike retail buyers, they don't chase headlines. They respond to risk models, debt levels, and currency stability. Their actions often mark the transition from early demand to sustained long-term pressure. At the same time, mining companies face rising costs. Energy prices, labor shortages, and regulatory pressure increase during economic stress. This makes expanding supply even harder. Some mines shut down, others reduce output. So while demand is accelerating, supply may actually be shrinking. This imbalance is one of the strongest drivers of long-lasting price spikes. As months pass, people begin to accept a new reality. They stop expecting things to return to normal quickly. This acceptance locks in demand. Precious metals are no longer seen as temporary hedges, but as core protection. Once this mindset takes hold across society, prices rarely return to pre-collapse levels. The damage to trust has already been done, and the demand it created does not disappear easily. Another important aspect of collapses is how interconnected markets amplify demand for precious metals. In today's world, financial systems are tightly linked. A banking crisis in one country can ripple across the globe within hours. Investors and ordinary people see the instability and immediately look for safety. Gold and silver, universally recognized and portable, become the default choice. This global rush intensifies pressure on supply far more than local crises ever could. In addition, currency devaluation plays a crucial role. When governments print money to stabilize failing economies, the value of existing cash falls. People start to realize that holding currency is a losing game if inflation accelerates. Precious metals, by contrast, retain intrinsic value. This drives both short-term panic buying and long-term accumulation. Each new collapse shows the same lesson. Paper loses, metals hold. A pattern emerges where initial spikes attract attention, and then secondary waves push demand even higher. Early buyers tend to be well-informed or financially sophisticated, reacting to subtle warning signs. Later, mainstream media coverage and visible shortages trigger the masses. Once physical stock becomes scarce, panic accelerates. This is why timing is everything. Investors who recognize early signals benefit most, while latecomers often face steep premiums. Industrial demand also plays a role, particularly for silver. Unlike gold, silver is heavily used in electronics, solar panels, and medical devices. During a crisis, production may slow or supply chains break, making existing silver even more valuable. Investors compete with industry for the same limited supply, driving prices higher. This dual pressure, investment plus industrial use, can create dramatic swings rarely seen in other commodities. Finally, psychological momentum cannot be underestimated. Once a collapse erodes trust, the fear of missing out amplifies buying behavior. People who would never have considered precious metals suddenly scramble to acquire them. This social and psychological aspect feeds the economic mechanics, creating a cycle where demand keeps rising even when prices are already high. Each crisis strengthens the habit of turning to gold and silver, reinforcing a centuries-old pattern that repeats without fail. Now let's dive into the rare but powerful moments in history when the silver-gold ratio reached extremes that most investors never see in their lifetime. In the late 1970s, for example, the ratio shot above 100 during periods of inflation and economic panic. Silver was dramatically undervalued compared to gold, and those who noticed this could have turned small investments into life-changing gains. Fast forward to the 1980 silver spike, when silver prices soared nearly tenfold in just months, while gold remained relatively stable. The ratio had signaled the opportunity weeks before the frenzy began, showing how powerful it can be when you understand history and timing. Even in the 21st century, similar patterns emerge. During the 2008 financial crisis, gold surged as a safe haven, while silver lagged, creating a spike in the ratio. By 2020, during the market panic caused by global uncertainty and inflation fears, the ratio again reached levels signaling undervaluation in silver. Investors who watched closely were able to take advantage of these swings, while others reacted too late, missing gains and suffering unnecessary stress. The lesson is clear. Extreme ratios are opportunities disguised as risk. Those who can read the signals benefit, while those who follow the crowd often lose out. The beauty of this indicator is that it combines numbers with human behavior. Panic, greed, and herd mentality push prices to extremes, but the ratio acts as a neutral guide, cutting through emotion. By studying these rare historical spikes, you learn how to spot when the market is overreacting, when one metal is cheap relative to the other, and when it may be time to adjust your strategy. For ordinary investors today, this means the difference between protecting wealth and watching it erode. It's a way to turn centuries of financial history into a practical, actionable tool for the present. We've come full circle, and now it's time to turn all this knowledge into action. Understanding the silver-gold ratio isn't just academic. It's a practical tool to protect your wealth and even spot opportunities in today's unpredictable markets. Start by checking the current prices of gold and silver and divide gold by silver to get the ratio. Compare it to the long-term historical average, roughly between 55 and 65. When the ratio climbs well above this range, silver is historically undervalued compared to gold, signaling a potential buying opportunity. When it drops far below, silver is relatively expensive and gold may offer better protection. Simple math, but with centuries of history backing its predictive power. Next, think about timing and patience. The ratio isn't about getting rich overnight. It's about seeing patterns, understanding cycles, and acting strategically while others panic. Use it alongside historical data, macroeconomic trends, and your own financial plan. Small, disciplined moves guided by the ratio can help hedge against inflation, preserve wealth, and even position you for gains during market swings. Remember, the ratio reflects human behavior over centuries: fear, greed, and overreaction. By studying it, you can make decisions based on logic and history rather than emotion and hype. Finally, put this knowledge to work in your daily investing practice. Track the ratio, study charts, note extreme highs and lows, and plan accordingly. Combine it with other indicators if you like, but never underestimate the simplicity and power of this single number. It's a compass for markets, a mirror of human behavior, and a guide for wealth preservation all rolled into one. If you've learned something new today, make sure to comment below and share this video with friends and family. Help them see the value of this timeless strategy too. Hit that like button if you found this valuable, subscribe for more insights like this, and turn on notifications so you never miss a video that could change the way you think about protecting and growing your wealth. History is repeating itself, and the silver-gold ratio is your key to understanding it. Don't wait for chaos to strike. Start observing, start learning, and start using this powerful tool today.